Okay, folks, we are graced with the presence of the one and only Marsten Parker. How are you doing, Marsten?
Doing well today, thanks.
So, for those who do not know, Marsten was featured in Jack Schwager's recent Unknown Market Wizards book. A fantastic book. Read it cover to cover in one sitting. When I got it, it was amazing. Incredible traders covered, not only in this recent Unknown Market Wizards book, but the entire series. And so Marsten kindly agreed to do an interview and have a chat with us here in Duggan Capital about systematic trading. So from where we are now, systematic trader, to where you were once upon a time budding violinist. That's where you started out. And how come you made the switch?
It wasn't really by choice. Yeah, in high school I was interested in classical music and violin, and I was also very interested in computer programming. This was in the late 70s, so we had mini computers, no personal computers yet, but we had one in our high school, and I was allowed to use it and learn to program. And then once the Apple II and then the IBM PC came out, I got access to those and kept at it. But meanwhile, I wanted to try my best at being a concert violinist, so I actually went to a conservatory in New York City rather than going to a regular college. And by the end of my 4 years there, it was clear to me that I could play, but I wasn't one of the best. I wasn't going to have a significant career in music, and this was now the early 80s when the personal computers were coming onto the scene, and I kept getting more and more interested in programming and realized that's what I wanted to do. So I moved back to Boston, where I'm from, and got a job working in a computer store, and kept writing code for my own purposes, and then eventually managed to get hired by a software startup. Worked for a couple of other software startups in the 80s and 90s. And then by dumb luck, one of them had an IPO in 96, and I had some shares. So I had some money, and for the first time in my life, I had an investment problem. And that's what led me into trading, is went through the steps of talking to financial advisors and deciding I wanted to manage my own money, and then, read a lot of books about the markets. And, I started out with I always wanted to do something systematic, with sort of longer term systematic investing ideas, stupid, simple things like dogs of the Dow or whatever, or running a monthly screen for the highest PE to growth ratio, or that, those kinds of things. And I eventually learned that my personality would favor shorter term and more technically oriented strategies. So
Okay.
that's kind of in a nutshell how I came to trading.
Was that a hard learned lesson?
Which one?
With regards to wanting to trade a shorter term shorter frequency system?
No, I just kind of realized that I liked. I think it came down to having an intuition early on for the law of large numbers. Like, if I was going to be doing something systematic, and as I got into getting data and back testing fairly early on, and if you would test an idea over 10 years and there were only 20 or 30 trades, that didn't seem statistically significant to me. I mean, I never studied statistics, but I had an intuition for that, and so I like the idea of something that was entering and exiting positions, at least most days of the week, so you could get up to 500 to 1,000 round trip trades in any year, and have some confidence that what had worked in the past might continue working.
Great. And very early on, there was mention that you were working with Gene Simons and the Medallion Fund, well, which is now the Medallion Fund. But I've read that book, The Man Who Solved the Markets, and one of the things that jumped out at me was the absolute effort towards their team very early on wanting to go back as far as they could to get as much data backwards, as they could in history, to the point where they were rummaging through records and really hand cobbling together databases of old New York Stock Exchange data to then be able to back test so far. So could you speak a little bit about your involvement there?
Yeah, I mean, that's a wonderful book. I highly recommend it to everybody. In that, at one point, it's briefly mentioned in that book that in the late 80s and early 90s, Jim Simons got involved in venture capital as a kind of side business to what he was trying to do in trading. And it's a bit of a stretch to say I worked for him. The software company that I worked for and was one of the founders of at that time, called Segway Software, is one of the companies that his venture fund invested in. So he was our largest shareholder and our chairman of the board. And I met him a few times, but that's the extent to which I can claim to have worked for him. I certainly never visited Medallion or have any idea what their trading strategies are. But I was sort of vaguely aware that, this guy who's our chairman has his money because he's a commodities trader, so it probably planted a few seeds in my mind of that trading is even a possibility. I might not have even known that trading was a field if it wasn't for having met him. But yeah, in terms of the data, that's very well described in that book. How the author kind of implies, and I would tend to agree, that the biggest source of their edge is probably their ability to obtain and manage and clean their data. As I understand it, they have data for everything, and it's all high quality. And then tools that let you try a bunch of stuff on it easily.
Fantastic.
Orders of magnitude at a smaller scale, but I had a similar intuition when I started out that I needed high quality data, and it was sort of hard to find in the mid 90s.
Right, and then so coming to your kind of first series of trades with Gary B. Smith, not to be confused with another Gary Smith, but you kind of started out with a sort of pseudo systematic system at that time.
Yeah, as I mentioned, I was looking for any kind of systematic approach to investing that made sense to me, and reading whatever I could, there were various people writing in various online publications in those early days of the internet, and so one of the more prominent ones then was TheStreet.com in its early days. So I read anybody who wrote on there, and Gary had a column called Technician's Take. And he was kind of unusually open among these kinds of writers about talking about, I trade, systematically. I use these rules. This is what I do every day. I run this scan and I look at the charts and I look for ones that fit a certain pattern, and I enter those, and I use fixed exit rules. And see, this is what I want. So I started corresponding with him, and to kind of pick his brain about all the details, since he was sharing something. I figured and he was very open and friendly, and I don't know, we hit it off, so we just kept corresponding. And then I decided to write some software so I could test the strategy and get data and try to refine it. And so we ended up becoming trading partners, where we would trade together every day throughout 1998. And had a very good year. That was my first profitable year, was trading with him. And then after that, I wanted to go pure systematic, including on the entries. So we kind of went in different directions, but we've stayed in touch.
Great. And so you're really, to talk about, like, to come from the systems and the setups, if you like, you were looking at then, to where you are now with the type of trading your system executes on now, like the parameters that you're looking at. Could you speak a little bit about where it is now in terms of, what are the parameters you're looking at?
Yeah, so back then, Gary's strategy was derived from the work of William O'Neill, the how to make money in stocks, basically the CAN-SLIM methodology, or the basic idea that you're buy high, sell higher. It's kind of it's not really trend following in the classic sense, but it's buying a breakout in it. And with looking at volume as an element as well. So a breakout to new highs on unusual volume in a stock with high relative strength. And Gary's twist on that, first of all, he didn't think all the fundamental elements in CAN-SLIM, which some of those are, some letters in that acronym stand for fundamental things. I don't remember which they are, but
yeah,
anyway,
that's right.
that was not relevant to him. He liked the pure chart-based, pure technical criteria, and he didn't like the original O'Neill strategy specified a 20% profit target and an 8% stop on all the trades. I mean, there was some discretion around that, but was the basic framework. So it was more of what I would call position trading. You would tend to hold things for several weeks before they would hit one of those. So Gary's refinement was to reduce the profit target down to 5%. So he would basically use this same kind of entry criteria from the technical point of view as that, and then set a 5% profit target and a 7% stop, and have about a 70% win rate on that.
Okay.
That approach worked great in the 90s, late 90s. Of course, practically any other approach would have worked great as well. So it doesn't say that much about the approach, but it had been working well for him for several years. He was very open with me about the kind of returns he was getting, and they were appealing. And so I got involved. So yeah, our daily process was to, update the data. We were using a very early version of Worden Telechart 2000, which is a charting package, but mostly they had very good data. Back then we had to dial up with a modem on our telephones and download each data every day. And
those telecharts were like sort of early version 1 Macs, weren't they, with a screen? They were like a specific machine, was that right?
No, the Telechart was the name of the software. It ran on a computer running DOS. Later they came out with a Windows version, but it just ran on the DOS operating system on an IBM PC type computer.
Oh, okay.
So right. But the key point about it was it provided a way to download, the daily bars for the entire universe of U.S. stocks, all major exchange listed U.S. stocks each night, and a way to write a scan. They had a very simple formula syntax, but you could without too much effort run a scan for, let's say, all the stocks that were up at least 4% yesterday with volume that was greater than the recent average.
Right.
So we'd start by running a scan like that, and that might produce, 50 symbols, let's say, and then you just flip through them and look at the charts on your screen, and then we would look for a period of flat consolidation, and then with yesterday's bar being a breakout to a new high, and that would be the entry signal.
Okay, and then
we would just pick the top, however many, probably five to 10 that look good, and
were you in on
market at the open the next day and set a bracket order. It became critical to find a broker that supported bracket orders, because most didn't in those days, but for the exit. So we wanted to be able to place the target and the stop orders and have one cancel the other.
You had to call in your stops otherwise, did you?
Yeah, but we didn't want to do that. The key point we both shared is, I don't want to sit there watching the market during the day. I want a daily trading process where I can run a scan, generate some orders, place those orders, and I'm done for the day, so I can do other things in my life. Yeah. So that was the basic model, and still basically my model of trading.
So that is still the model that you're using today.
Yeah, I did go through a period where my systems were trading intraday using live intraday data, but not so much, not like in and out multiple times a day. It's just that I realized that, as I said, I started out entering at the next open, and then at some point I realized that it was better to enter right before the close if you could anticipate which ones, so that you can catch the movement from other people entering at the open. And then later it became apparent that entering even earlier in the day was better. So then that required using live data and doing a kind of real-time calculation of anticipated volume to know whether it's going to be above average, probably
So that
at the close.
so that brings us on to something that we were talking about before, which is RVOL. And I know it's really big with equity traders. We trade futures, so but we don't use it that much as a tool. But we're always hunting for tools that can tell us exactly how dead or busy is it going to be today, in advance of time, or just anything that would give us even 5 seconds warning to busy or dead conditions. It kind of has become a bit of a sixth sense to most of us on our team to just either know it's going to be quiet or busy conditions. But RVOL, I think it's kind of an agnostic tool to a market. Could you speak a little bit about RVOL in terms of maybe what your thoughts are on it, or do you use it? Or
Sure. Yeah, for the first, what, 15 or so years that I was trading, it was one of the key few factors that I was using. I should say that whole breakout trading approach that I just outlined, I basically stopped using it in 2014. So I transitioned to being more of a mean reversion trader. Although I do have one short-term trend following strategy that I also run, but I no longer use volume at all. But for those breakouts back then, especially, it did seem to make quite a difference, especially unusual volume early in the day. When I got into the intraday scanning, I found that. And yeah, it was, as you say, RVOL, or relative volume. So it's, how's today's volume compared to the recent average volume? What you're basically looking for is there unusual volume? And I was generally looking for anywhere from 1.5. I think when I started out, I wanted at least 1.5 times average, and that kept kind of increasing. At the end of the period where I was using volume, I was requiring 3 times the recent average volume to even be an entry signal.
And over what sort of look back period were you running?
I think I originally started with 20 days, and then it gradually shortened. I think I might have been using 9 or 10 days towards the end.
Interesting.
And I would, when I was doing it intraday, I would use 1 minute bars to figure out on a, there's kind of a curve where there's more volume near the open, and then it tapers off midday, and then there's more near the close. So for each minute of the day, I had a percentage of what percent of the day's total volume is on average accumulated by this minute. And so then by using that table of values, I could see, okay, how much volume in this stock is there so far today, and therefore is it projected to be 3 times average by the close or not? Of course, it didn't always work out that way, but it was close enough, and so I would use that as my entry criteria, starting at like 9:35 a.m.
So you were running an RVOL over each minute of a session, and then kind of looking to plot from there.
Well, I didn't do it for that particular stock. I just did it on average. Like I would crunch a lot of data. So I'd take all the stocks going back a year and look and take all those many, 1 minute bars, and for each minute calculate an average of what fraction of the eventual daily volume has been accomplished by this minute.
Okay.
So I just use that as a general average to estimate the probability that this particular stock was going to have 3 times average volume, and that was one of the. So if it was up by a certain percent, and over yesterday's close, and had the right. My setup was basically 3 things. It has to be near all-time highs, or near, not all-time, but like near multi-day highs, but not very far above. So the ideal thing would have maybe a recent high 20 bars ago, and it would be very close to that price now, not extended above it. And then from there you would get the breakout on unusual volume.
I
And
got you.
in bull markets, that kind of approach will still work. To tell the truth, I haven't had whole market intraday data for like 7 or 8 years now, so I haven't even researched to see how this approach would have been working recently. But my suspicion is that the RVOL is less useful now than it used to be.
Right.
And a lot of the reason for that is because of the fracturing of the U.S. market into so many different exchanges and the dark pools. And there's a weird thing about how data services report daily volume. The daily volume figure that you see in any daily, OHLCV data series is all the shares that traded on that entire calendar date. So that includes pre-open and post-close. I don't know why they do it that way, but that's been how they do it forever. Which is strange because the high and the low price does not include pre-market or post-market hours, but the volume does. I don't know why. And also the volume includes all the dark pool trades that may have happened, which if you're trading live, you see the FINRA prints on the tick on the time and sales, but those don't have to be printed when they occur. They could have occurred a few minutes ago. So the notion that what the real volume is on a live basis is no longer as valid as it used to be.
So you've got a busted time and sales essentially as well.
Yeah, I mean, I think it's a general concern in the markets that there's kind of decreasing transparency, and the big players are lobbying for that because they're tired of having little parasites like me trying to front run them. But
I have a sneaking bug about footprinting, and look, I have a lot of respect for everyone using footprinting, and good luck. But from kind of being trained as a sort of high speed sort of scalper, well, not high speed, but in terms of just really picking out very small little nooks in a move, just really living by reading what's happening on the tape and reading size being presented here and there on the ladder. I kind of look at footprinting and I'm like, well, the footprinting is not going to show you someone spoofing size that's like 5 times bigger than any other size on the book. It's just going to come up there, the guy comes off the book, and then we sell through the level. You're not going to see that on footprinting. The book is
kind of somewhat an artificial thing that's being painted by
and
people as a signaling mechanism.
And if you're cynical enough to understand that spoofing might be illegal, but you're not going to be able to hand out speeding tickets at an F1 race sort of thing. So and I used to trade with guys who would kind of just make it a point, they'd see someone spoofing and they might be kind of spoofing directionally against these guys I was sitting with, and the guys would be like, this, they'd be shouting at the screen, I can't believe this guy is spoofing, and they'd take a note down, they report it to the CME, and so it's like you can't believe everything you read, I don't think, on a footprint. And I think there's a more granularity to reading the ladder, and so that's what we do in our group. We try to read into this stuff a lot more, and you can scalp into something and then maybe run a position. But
that's a fascinating. I mean, that's down at a lower level than I've ever been. I mean, even my sort of fastest intraday trading interval was 1 minute. I mean, I had a 1 minute timer where I was scanning for my entries once a minute, and so I've never been looking at level 2, looking at the tape or the order book. I mean, except for casually doing it for my own interest, but not in terms of an input to my trading. But I mean, that spoof, that whole, that comes into like the flash crash and that whole book about Navinder Singh, and it's fascinating stuff for sure. Yeah,
it's 100% knackering and tiring.
Right.
But so to really, that transitions into a project that we were looking at in Duggan Capital last year, and we ran it for 6 months, where we had some quants, really not so much quants, but mathematicians, and guys and girls who are experts in machine learning wanting to run a project to take a discretionary edge and to form that into a systematic edge. And while we found some really good stuff at the start, when we dove deeper into actually trying to get an executable systematic trading system that would autonomously execute in and out, we just couldn't get it over the line at the in the last kind of 2 months, where it really came to, we found the great edge that we could code up, but then when it came to practical application, we couldn't find how we could execute this with the right type of risk profile. And I mean, the targets, we just set targets, we were looking for X amount, right, of tick value or percentile, but mainly tick value. But it was really just streamlining those entries. And I just thought, it's such an opportunity to be able to ask you about that. And I know you said you're not a quant per se, but if anyone knows about systematic trading, it's definitely you.
Yeah, I mean, maybe there's a little overlap in those two Venn diagrams. Yeah, I mean, I never even studied math or maths, as you would call it, at the college level. So I'm definitely not a real quant. I couldn't get a job in quant finance at an investment bank, certainly. But as I described, I was just kind of coming at it bottom up of, okay, how do I come up with a systematic strategy that I can be comfortable using on a daily basis, keeping it as simple as possible. What's the minimum I can test, and so on. Now, I have from time to time, gotten to know some discretionary traders who, for example, use chart patterns and then tried to backtest some of those things for them. Including a couple who were very profitable, and in their mind, what they're doing is completely mechanical. I think at some point a discretionary trader takes for granted the intuitive component that they're using. This, when you do something by intuition, kind of by definition, it's second nature. So you're not really aware that you're doing it. If you think about your expertise in walking, you definitely take that for granted. But if you tried to quantify the process of walking, I guess people in robotics are doing that. It becomes pretty interesting. So, but the people who trade off charts and look for all these different nuances in the chart layout, in my opinion, there's actually no edge in any chart nuance. But that helps. And they're basically, their main edge is they know what stocks are in play, and the charts help them feel confident to enter their positions. But I have tried to model some of these highly nuanced chart patterns, and have never gotten anywhere with it. I mean, I've come fairly close to but once you account for every detail that a person looks for, you end up not finding any stocks on any given day that actually fit all the criteria, because there's always a little exception. There's gray areas. It looks a little like this, but not really.
So well, from how I look at it personally, is there's harmonic patterns, which are like, your wedges and trends and all that sort of stuff. And then there's sort of mathematical value, where things are cheap or expensive, or cheap and they're going to get cheaper for fundamental reasons. But then there's like this, then there's kind of like the parameter mechanism of systematic trading, which kind of still eludes me, to be honest, especially for the entries. I think once you get like an entry signal, it's then actually executing the optimal entry after you get like say a bullish scenario signal, right? You were saying you went from open it, or a market order open trade the next day on a bullish signal, to trying to optimize that to a specific time of day. And that seems to be the biggest, most elusive part of the execution of actually getting the best entry.
I mean, even when I did go down to that 1 minute granularity, it was still very, very fuzzy. I mean, when you do anything systematically, you're looking at a few thousand or more past trades and trying a bunch of parameters and saying, okay, which parameters work best on average across all these trades. So, I mean, in theory, that would have a better probability of working in the future. Maybe not, but I mean, that's the big sort of debate. But even so, I mean, even if you can get down to the sub-minute level and figure out what parameters would have worked best over the last 1 million potential entries, on the very next entry you're going to take, that's not going to be the best parameter. It might be, it might be or it might not. But so I think, a discretionary trader who's watching the tape and has situational awareness about it, and on some level, every trade is different, and you can develop some intuition that helps you understand that. And I think that's why, I mean, it's well documented in the latest Market Wizards book that all the discretionary people have better stats than, I mean, I have the worst stats in the book by a mile.
Well, not over the time period.
Right. The longevity is the saving grace, and that's a benefit of a systematic approach, is it makes consistency easier.
So
although you're not going to find a system that'll work for 20 years, so you have to have a process where you're doing research. But in terms of daily execution, there's no issue. I can even trade when I'm on vacation or whatever. It takes 5 minutes a day.
And do you have a server near an exchange or with your broker?
No. I don't do anything in that high frequency realm. Latency is not even an issue for me at all.
Oh, okay.
I mean, I could practically implement how I'm trading now with orders that are all placed when the market's not even open. There's one nuance where I require live data, and because I like to, select, let's say 40 stocks for a mean reversion strategy, and I only want to take the first 10 that happen to hit their limit entry prices.
Okay.
And so, but I don't want to place all 40 orders and risk getting filled if there's a flash crash. So I have some execution software that uses real-time data to constantly sort all 40 by how far they are from their trigger prices, and cancel the farther away orders and place the nearer orders, and so on, just to get me into the ones that hit first reliably. Because sometimes they hit for only very briefly, so you need your limit order there in advance. Right. And I think there's also some advantage to actually showing your size, so because everybody's looking for liquidity. I used to think you had to use hidden limit orders, otherwise you'd be front run all the time, or someone would go one tick in front of you, and that happens. But I think the trade-off, it's better to show you. I mean, of course, if I was a hedge fund, wanting to sell or buy 1 million shares, different story. But for my little few thousand shares, it seems to work out.
We've recently done sort of an educational course in Duggan Capital on trading the ladder and reading the ladder and size. And one of the biggest takeaways that we have in there is, if you see size on the book, and say the market's trading tens, and it's just auction, and then suddenly, like, the average price or volume on a size or on a price is like 20 contracts, and then suddenly you see like 500 lot come on the offer above. It's like, well, the market's going to want to take that size. And
right.
And one of the biggest things is kind of teaching people that's like, well, if it gets up there, it doesn't mean that this is a ceiling. It's actually, if anything, this guy might be spoofing. We get up there and he actually joins the bid, and then up we go. It's all these dynamics. So,
right. And I think it's quite a different dynamic in these highly liquid futures contract. I mean, like if you're looking at ES futures, that's a totally different ballgame from your typical stock. Yeah. I mean, to some extent, maybe the most active, largest stocks like, Google, Apple, et cetera, are going to have some of those characteristics, mostly because of, statistical arbitrage. But but for the stocks I'm typically trading, it's a different dynamic entirely.
So I'd say it's very rare that you get like large size spoofing. on the
Yeah,
book
I don't think it's a
on
factor in
stocks.
most stocks in the
Yeah.
I avoid the thinnest ones, but
Mm.
I'll trade anything that has, let's say, 100,000 shares daily average volume and or up.
Okay.
So that still leaves like a pretty large universe.
Yeah. That's still pretty light. I would have imagined 100,000 shares in a day.
Yeah, I mean with I don't trade penny stocks either. So let's say 100,000 shares in price above 10, for example.
Yeah. Right. So yeah, you're not
$1
trading
million
it.
volume or
You're not trading
higher.
the pink sheets.
Certainly not. Yeah,
With
you don't even know what the bid and ask is on those things.
80% daily average moves.
Right.
And so just kind of on machine learning, to coming back to, how simplified your system is. I mean, have you thought about the potential for machine learning to be able to aid in what you're doing?
Certainly, I've thought about it and looked at it a little. I tend to shy away from complexity, probably a little too much. I have this extreme simplicity bias, so I've avoided that. I mean, and I tend to reject, well, anything that, for example, I would never trade a system on just one symbol. To me, it's just so likely to overfit that.
Okay.
So I very much like the kind of strategy where you say, take this rule and scan this large universe of stocks every day, and take the top X based on some ranking factor, and then apply some kind of entry criteria to those. And so I suppose you could throw a neural net at that. I mean, I went through a phase around 2006 to 8 or so where I was in my backtesting software, I added a genetic optimization mode, and I was trying all sorts of different entry and exit rules with all sorts of different parameters, and letting it do this genetic process of randomly varying some of the parameters while keeping the prior best values of others. And I don't know enough about machine learning to know whether that's anything like the current processes. It's probably a lot more simplistic, but that's a way you can take a set of parameters where you couldn't possibly test all the combinations because it would be in the trillions or something, and the back just would run for the rest of your life. But you can use this kind of genetic process to quickly come across what's probably the best island of combinations. And I was doing that on a walk forward basis for a little while, but this was still within that kind of breakout strategy that I described that I had been using back then.
Were you
so I was
using
just taking the few parameters. I mean, like, for example, the volume surge, volume over average was one of those parameters, and how far below the recent high, and things like that. So I would take any parameter that I had and try and optimize them all together.
Right.
But I didn't find, and then I would study that kind of walk forward process of, well, how often did the best set from the prior period end up being one of the better ones in the next period? And I found it ended up being fairly random.
Right.
So I favor the approach where I basically do very little optimization. I mean, maybe I'm somewhat applying hindsight bias because I've done so many tests that I have a feel for what types of parameters work with what types of systems, but I just kind of pick round numbers that make sense and go with that. I'm really just trying to capture the basic concepts like 1 day mean reversion, 3 day mean reversion, short-term breakouts, short-term momentum in both directions.
So moving on to volatility and dampening volatility, and something that you mentioned in your interview in the book was you had diversification across not markets, but actually diversification of systems, essentially, that were different systematic strategies all working at once that were uncorrelated. And it made me think about Ray Dalio's sort of volatility dampening mechanism, where he has portfolios like his all-weather portfolio where he just throws in so much uncorrelated stuff that it just crushes the volatility in the portfolio. Can you speak a little bit about maybe, putting all those different systems into sort of your one portfolio?
Yeah, for sure. So when I started out, and I probably got this from my first partner, Gary B. Smith, because he was in these articles that he was writing. He talked about trading both the long side and the short side, and at that time I didn't even know that there was such a thing as the short side. I just thought people invest, but so I quickly learned about that and came up to speed. And so from the very beginning, from '98, I was
typical
I had
US
at least
stock
that
traders.
level of diversification. I wanted to always have both long and short positions going. As long as there were setups to do it. I should also point out from the very beginning, I never embraced the idea that you have a portfolio, or that you have holdings. It's always been a trading mechanism. To me, a portfolio is a collection of strategies, and a strategy is a trading process. So I don't really care. Like some people who encounter the way I trade are like, but your money's not all at work all the time. I don't really care how much of my account is in cash or not on any given day or overnight. The money's just there to enable the trading process that I want to run. I think to futures traders, this is more obvious because there's no concept that you're using all your capital. I mean, if you were using all your capital in your futures, you'd quickly go broke because the margin level is so high. So you're always only using a tiny bit of your capital, and it's just sitting there as margin. So, but anyway, so I always ran a long and a short strategy, and and that's why from '98 until 2013, I finally had a losing year. But all those other years, including 2000, 2001, 2008, were positive years for me because I always had the short side going, and it more than made up for the losses of the long side. And because I use short-term strategies where, I'm not going to take long entries unless something's breaking out to a new high. So also that I would tend to not have very many long positions on during a pullback.
So sorry, just to clarify, that you were running a strategy where you had a bucket of essentially short systems and a bucket of long.
No, I just had one long system and one short system.
Oh, okay.
For the entire period from 1998 until through 2013.
Okay.
And once we got into the decade between 2010 and 2020, that's when the real quantitative easing and buy the dip mentality came in, and so on. So things started to fall apart for me basically when the short side stopped working. My bread and butter short setup was to look for a big breakdown in a stock that had just been near a high and short, and it would almost always continue down for 3 or 4 more days.
So in like February, March, April 2020, this thing must have been on fire.
Could have been. I don't know. I don't run those strategies anymore.
Oh, sorry. Okay.
Although, I mean, I do going back to some of my old end of day versions, and they actually would have done that. My old short strategy that made me a lot of money in the year 2000 would have done pretty well the first half of this year, actually. But that's the first time since in the last 15 years that it would have done well.
Right.
So,
well, that's a long time to wait for it.
I've long ago abandoned it, but and it was fairly short lived. I think I have better approaches now. But to getting back to your original question in terms of diversification, so I had some from the start by being long and short, and I noticed right away that how, because I would always something that I did from the beginning, which I think is valuable, is I had the discipline to enter my daily trades and returns in an Excel worksheet every day. At first it was manual, and plot and calculate and plot the daily, the equity curves on a daily basis. So I would be looking at the longs, the shorts, and the combined results. So I would look at this graph evolve during the year every day, and you can see at a glance from that the combined curve stays smooth while the individual curves go in opposite directions. So I think I got an intuitive sense of the value of diversification from that very simplistic example. Later, when those breakout strategies stopped working and I could no longer even find versions of them that had worked recently, I went looking for other approaches and came across the idea of short-term mean reversion, where you're basically scanning for the most oversold stocks and then placing limit order to enter tomorrow even lower. You're basically catching a falling knife, but keeping size small enough to keep that safe. And it's a probability game. So and doing the opposite on the short side.
What were the average kind of risk rewards on those mean reversions? Probably double digit sort of stuff.
Well, there's no stop involved, so you can't really. I mean, your risk is your whole position, basically. But it's very rare for a stock to go to zero in a few days. So in practice, you're not. But now anyway, I would never put more than say 5% of my account in any one position. So and it's so in theory it could go to zero. I mean, as it happens right now, I'm sitting in a position in what's that? Some Russian stock, Zandex, XNDX, which of course it's halted. We're unallowed to trade Russian stocks now in the U.S. since March when they invaded Ukraine. So
oh no,
it might go to zero. Worst case scenario, if it goes to zero, that's a 5% account hit. I mean, it's already like a 2% account hit where it is now, according to IB's theoretical mark to market of the thing.
All right, okay.
But that's one trade. It's like at the end of the year, I'm looking at a plot with 1,000 or 2,000 dots on it of all my trades, and you'll see a few outliers in both directions, and they cancel out, and you just kind of don't worry about it.
So that kind of segues into my next question is, and I try to ask most traders that I interview for the channel is, what are the most common reasons for failure that you observe or that have come to your mind in your years being in the markets? I think there's a huge vantage point that you get to after being in the markets for 5 years, 10 years, and 20 years. And maybe to just kind of give some advice to people who are starting out in their first 6 months, first year, first 2 years of trading.
Yeah, I mean, I think the number one factor is probably patience. I mean, you've got to start out small. You have to be willing to let it be boring for a long time. And I'm speaking from experience here because I struggled with this myself. I've gone through near failures a bunch of times. At one point I got into trying to discretionarily trade the ES futures on, intraday, and
you were telling me
it just
about that
became
before,
almost like a slot machine for me. Of like, oh look, I think it's going now. I'm going to hop on. Nope, it's that kind of thing. And threw away some money that way. So that's the simplest thing to avoid for new traders. Just don't look for action. Don't gamble like that. You should never enter a position unless it's part of a setup or a strategy that you've designed and verified. Otherwise, just wait. Trading is mainly about waiting for the next setup. It's much easier when you're automated because you're not even watching the market anyway. But if you are, I think your prior guest Jason Shapiro talks about this, of the necessity of just sitting there and waiting for a valid setup and how boring that can be. And if you can't handle that boredom, then don't trade. So I would concur with that. In terms of the other obvious cause of failure is people who trade too large. They're like, oh, I just know this. I have such high conviction in this position, and so I'm going to put a huge size on. And then when you have that much conviction, it's harder to admit you're wrong. So you don't sell if it goes the other way and so on. Yeah, it's a two-edged sword because if you read the Market Wizards book, you'll see that a lot of the best discretionary traders, that being able to differentiate between a high conviction and a low conviction trade is one of their biggest assets. So if you really know from all your experience and so on that everything's lining up, don't tell George Soros to not have high conviction when he shorted the British pound, for example. He knew he had all the right information. It still could have gone against him, and of course when we read all these stories, there's a huge element of survivorship bias because we're reading about the lucky ones who took big positions and didn't get blown out. But that's that. But from my point of view, I've gone through some periods where I got overconfident. Like when I first discovered mean reversion and did some backtesting and came up with some strategies, I couldn't believe how much better the stats were than the stuff I was trading earlier. And I'm like, shoot, why didn't I discover this? I still started small, but then the live results were just as good as the backtests. And I just said, okay, I'm going to just keep increasing my size in this thing. And then, it was favorable market conditions for a while. And then this was in 2015. And when we get into the fall of 2015, there was, I don't remember what the catalyst was, but there was some big issue. Like August 24th, 2015 was one of the biggest down days we've had in recent years. And then that continued into 2016. I think it may have been like one of the earlier alarm bells about the Fed raising rates. Maybe, I don't know. I don't remember. But anyway, I had my worst drawdown ever during that period. I ended up having a 45% drawdown because I was trading too large, so I was overconfident.
Wow.
And I was putting all my eggs in the mean reversion basket, just two strategies, a long and a short mean reversion. I mean whereas with breakouts and breakdowns, they do tend to hedge each other, but with long short mean reversion, they don't, because you don't tend to get, when the market's crashing, you don't get any short entries because nothing's overbought. That's nothing short-term overbought in those conditions, and vice versa.
I've certainly seen that trading on a desk in a prop firm, mean reversion guys on bonds, on ags, on softs, in futures, and when volatility is below like maybe 25s or actually used to be below 16s, it was great. They'd just be spread, they're long short on a spread, just trading the compression back. But when things kind of got a bit out of whack, they were having a martingale basically into those
all the
spreads.
Correlations go to one. Now that's a different strategy than when I say mean reversion, I'm not talking about spread trading and or stat arb. I basically take the long and the short side completely independently. So for the longs, I'm just scanning for the most oversold stocks and taking directional bets on them that they'll rebound, and vice versa for the shorts. And I don't care whether the stocks are correlated or not theoretically in the past or whatever. I just take whatever's the most extreme. It's just the basic principle that the most extreme things are gonna revert because the rubber band's stretched too far. It's very simplistic.
You've kind of got the aggregate there on the index as well. That's at play in a way, I suppose.
It works most of the time. But the other pitfall specifically for people trying to get into systematic trading is kind of the pursuit of the holy grail / overfitting. There's kind of one dimension of that is the person who keeps getting more tools and more data and testing more things and buying off the shelf strategies and never actually trading because they're looking for a completely for an equity curve like that. So that's a risk. So you kind of have to embrace the randomness and the uncertainty and settle for something that's good enough, and settle for the fact that you can never try most of the ideas that are out there. Just pick a basic thing. It's really only really two basic things: momentum and mean reversion. So you pick a universe, you pick a time frame, and you use one of those principles. and then kind of mix and match different combinations of them into a portfolio of strategies.
Recently we were myself and a friend, a computer science professor who's interested, who trades crypto, and I trade a bit of crypto, and he got really hyped up about some of these scalper, off-the-shelf scalper strategies, basically systematic sort of scalping strategy bots that you can get that will trade crypto markets. And we did quite a bit of research, and then he presented a couple of different bots, and the maths worked out. He liked it, and then I thought, hold on, I'm going to go on one of the Discord communities where the people who are using these bots are talking. And sure enough, I went in there, and it was just user after user saying, we're not making any money at all. These things are doing nothing. So all the reported stats were just, I don't know, from some picture perfect market point.
It's probably from back testing it without properly accounting for transaction costs, for the spread.
Right.
That's another classic error that people can fall into with systematic trading, is you try a bunch of different things and you discover that the shorter term and higher trade count you get, the smoother and better equity curve. And sometimes you end up with, oh, this thing takes 20,000 trades a year, and each one has an expectancy of 0.05%, but it makes a beautiful smooth equity curve. It's like, yeah, if you can get all those fills.
And if your broker's not taking 0.03%,
right. So yeah, you got to make sure your back testing model is realistic in terms of commissions and slippage and so on.
So that leads us on to final question, really, is, what is your best advice for people who want to get into systematic trading? I know there's going to be a large mixture of people watching this who trade futures, trade stocks. Some people won't be programmers. Some people will know a little bit about programming. Some people, like me, are not programmers, but may be looking to want to go to a systematic place and really remove a lot of the psychological traumas, if you like, that are associated with live intraday execution. What are some of the what are some of the resources, maybe? What's your advice?
Well, if you're going to end up trading systematically for a long time, you have to end up where you have a process that lets you experiment, that lets you test things and compare different things and decide which things to run, and also that lets you test the things you're running against other things to see if maybe they're losing some of their edge and I should switch to something else, and so on. So the most important thing is to end up with kind of your own workstation where you can do this kind of research on your own computer. And it takes time. There's a learning curve, and you probably have to pay for some data. You might have to buy some software, but yeah, you might have to try a few platforms till you find one that works for you. But you have to end up with something that you're able to use, where you can run experiments. It doesn't necessarily have to involve coding, but you have to at least be able to set some parameters and run some experiments, and you have to be able to drill down into seeing the list of trades that it would have done and verifying them, and to make sure you're confident in the results. Whatever platform you're running, it's good to independently verify the results. This could be by copying the trade list into an Excel worksheet and calculating your own stats from it, for example, or whatever.
I did talk to a trader.
I
did talk to a trader recently who was back testing against Google daily open, high, low, close data, and I was like, I don't know if that's reputable data to be using for back testing a whole lot of strategies. I think
there's been some issues. I mean, you can have two or three different data sources and run comparisons to make sure they match. You can also easily go too far down that rabbit hole of wanting your whole environment to be perfect. So it's a balancing act. I mean, and if if the whole strategy depends on everything being perfect and a tiny variation throws the results off, then it's not a robust strategy anyway. So that's the other way to look at it. But so tools, I mean, what I personally use, I have my own backtesting software. As I mentioned, way back in the 90s when I first started working with Gary Smith, I wrote some code to test the things we were doing. At first, it was just hard coded around that, but over time, it just kept evolving and becoming more generalized, and still use it today. It's now once the Market Wizards book came out, I decided to also offer it as a product. I've always had 4 or 5 other traders who I've been in touch with and who are using my software and trading the way I have, just so I'm not just isolated and doing it by myself.
So how could we?
That's been good for me. So yeah,
so how could people check that out?
Yeah, the software itself is called RealTest, because it's like a real trader's backtesting tool, and it does the most realistic backtest of any daily bar-based software. It's really it does support futures. I actually have an example script of the original Turtle system in there, for example. But it's a daily bar based. It can go up to weekly and monthly, but it doesn't do intraday at the moment. And the kind of system where you're scanning a universe of things for your trades on a daily basis is what it excels at. So it lets you combine any number of different strategies that do that. It works best with Norgate Data, which is an Australian data company who has excellent data for the U.S. markets, the Australian markets, the Canadian markets, and the futures.
Okay. And do you have?
My website is mhptrading.com. MHP is my initials. Or you can Google RealTest and it'll come. You'll find it. It's the first thing that comes up, even though I've never done any SEO.
All right. And so you got the Turtle strategy. That was a 2-week range breakout, wasn't it? Or
it's a couple. I followed
2-week bar.
I used all the rules from the book by Curtis Faith. I think there are different versions of the rules and some debate about which ones are correct, but that's the clearest set I could find. So I just, I put it in there as an example script for that.
Okay.
One of the big benefits with my software is it comes with a big library of example scripts of all kinds of strategies, including some that are currently profitable and or recently profitable, I should say. I never claim that it's going to be profitable in the future. But
so I could go in there and have a look at like a golden cross momentum strategy, or something like that.
Yeah, or I mean, I've got some more. For example, a lot of people trade a NASDAQ 100 rotational strategy where every month you buy the top 5 by momentum, and I've got a version of that. I mean, the Ray Dalio all weather strategy. I have an example of that. There's a bunch of other ETF based. There's something vigilant asset allocation, and there's some site called Allocate Smartly that has a bunch of things that people have asked. Basically, these have all come from where users of the software have asked me to how do I implement this strategy that I read about.
Right.
There's a book by a guy named Lawrence Bensdorp called Automated Stock Trading, I think. And that's actually the closest to how I trade, because he outlines an approach where you combine 7 strategies into one system.
Interesting.
And he discloses them all. And I've got a complete model of that book among my example scripts. A bunch of things like that. Great.
Brilliant. Well, listen, thank you so much for your time, Marsten Parker. It's been a pleasure. Really hope to talk to you in the future, get you back on and see how you've been doing and what's shaking in the world of systematic trading. But for now, thank you very much for your time.
Thank you, Tim. It's been a great interview.